Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. What I would like to do today is look at 10 companies that are in the Nasdaq. The 100 consists of basically the high growth companies. Some of these high growth companies are becoming mature companies. Some of them are still basically in that high growth phase, if you like. Some of them are not profitable yet, some of them are just becoming profitable, and so on. So it's a mixture of companies in that 100 Nasdaq companies. Now, when you're building your own portfolio, of course, you're going to have to do similar thing where you have a high growth companies, where you've got dividend paying companies, you've got the mature companies. So when you're building your portfolio, you need to look for the price appreciation. So companies that are basically growing their revenues fast and so on, as well as, of course, these old dinosaur free cash flow machines that pay that dividend as well. So it's a mixture of everything. So I'm going to share with you guys 10 companies that you could potentially look into. Some of these companies are overvalued right now. So if we see a pullback in the market in the next few months and so on, they probably will be a better buy than right now. And some of them are fairly valued and so on. But before we get to that, like the video, subscribe to the channel. If you have any questions, let me know. And join us in Patreon account where you get access to all of these things. You know, when it comes to buys and sells that I make regularly, the dividend trackers, you've got ETF trackers, you've got the Discord where a lot of brothers and sisters are sharing good practices, and you got the Sharia compliant investing ebook, and all of that will cost you about 15p per day and will definitely help the channel. Now, looking at the fear and greed index, basically the markets are kind of flat in the last basically a month or so. So the S&P 500 is only up 0.5 for a year to date is about 10%. The QQQ, which is basically what we're looking at today, basically year to date is up about 10%, and the last month is just basically down a little bit. The Dow Jones Industrial is about 4 or 5% up since the beginning of the year, and the last 5 days is about actually up 2%, which is quite nice for the Dow Jones and so on. So what I'm going to do now is share with you guys 10 companies that are in the Nasdaq and are Sharia compliant. And some of these companies, again, like I've always said to you guys, do your own research because they are quite volatile. There's a lot of these companies in there are quite volatile. So especially with those high growth companies and so on. So let's get started. And first company we're looking at today is AMD. AMD is one of those companies that we've talked about a lot. I'm sure a lot of you know about it. They are chip making companies. They design it. They don't make the actual, they're not manufacturer, but they are actually they design it, send it to TSMC and so on, and then they make it for them. Right now, 250 billion market cap. It has a narrow economic mode, $151 per share. EPS right now is 0.69. PE right now 221. Forward PE 44. PEG ratio up below 1. Now, what we're looking for when it comes to PEG ratio below 1, that tells us it's actually quite cheap, this stock, in comparison to PEG ratios above 2 or 3, that's super expensive. So anything below 1, that's what we're looking for. 1.5, I normally say it's okay. 2, you're pushing it. 3 is too expensive. For even 2 is still too expensive. The 5-year revenue in terms of revenue side with 33%, and this is where these companies shine. And so when you look at the 5-year EPS and the 5-year 48, almost to 49% profit margin, it's not 5% right now. Return on equity just about 2%. Return on invested capital just 1%. Current ratio is above 1, which means the company has enough liquid assets in the next 12 months to actually pay for if there's any liabilities. And total return the last 10, so free cash flow of $1.1 billion. Total return the last 10 years, we're looking at 44%. Growth estimate next year almost is 60%, 23% after that. Fairly valued, $149 per share. Now, TSMC came up the other day and actually said the markets, when it comes to chip world, is actually they're doing really well. The demand is absolutely crazy. I think they've gone up, revenue went up or 60% or something like that. I can't remember. So if that continues, I think chip companies will probably, semiconductor companies will do really well in the coming months. Next one is Adobe, one that has been hit very much in the last couple of months. right now is trading $482 per share, 221 billion market cap. EPS right now over $10 per share. PE 46, forward PE, that's current PE, this is forward PE 27, and PEG ratio below 2, which is not bad at all. 5-year growth rate in terms of revenue side of things, we're looking at about 17%. 19-20% in terms of EPS, profit margin 24%, return on equity 32%, return on invested capital 36%, which is absolutely amazing. Current ratio up is above 1, free cash flow $6.4 billion, total return the last 10 years 24%, double-digit growth expected in the next couple of years, in 5 years. Right now, 19% discounted, $610 per share is where they think the price should be. I'm really attracted to this guy. I don't know. I might have to initiate a new buy for when it comes to Adobe. I'll let you guys know, but it seems very, very attractive. The only issue with this company that people are talking about is the AI situation. So because of AI and what AI, can do right now moving forward in terms of image creation and video creation, people are saying, okay, of course it's going to hit the revenue for this company, but they also have AI side of their business as well, so it will be interesting to see. I might have to dig deeper a little bit more before investing in this one. Right now, next one is Zscaler, which is a cybersecurity company, $26 billion right now in terms of market cap. Narrow economic mode price right now $174 per share. EPS is negative. For that reason, current PE is not, basically the E part is not there, so for that reason PE is non-existent. Forward PE though for 54 and PEG ratio below 1, which means it seems very, very cheap right now. 5 year in terms of the revenue side of it, 52%, and in terms of 52% and 51% when it comes to revenue and when it comes to EPS. Profit margin is non-existent. Of course, all of this is negative right now. Current ratio is above 1, which is good. They have over $500 million of free cash flow right now. Total return in the last 3 years, I think. I put star there because that means the last only 3 years, because the company has not been around that long. 21%. Current ratio, I think this one was the last 5 years. Current growth estimate for the next year 19%, 38% after that every single year. 16% discount right now. $213 per share is where the price should be according to Morningstar. Next one is one I own in the portfolio, Intuit, and again this is still a high growth company in my opinion. $180 billion, wide economic mode, $632 per share. EPS right now closer to $10 per share. PE 64, forward PE 34, PEG ratio below 2. 5-year average in terms of revenue side of it, and in terms of EPS 19 and 16%, which is not bad. Profit margin 18%, return on equity 16%, and return on invested capital of 15%. Current ratio, we're looking at ratio, looking about 1.17, which is good. Free cash flow $4.6 billion. Total return the last 10 years 24%. 24% expected to grow the earnings to 24%, then 10% after that. 25% premium right now. $500 per share is where they think the price should be. I do agree with this. I wouldn't touch it right now, this company. Next one is another semiconductor company. That's Texas Instrument. It's been around for a very long time, but look at the growth side of things. It is expensive right now. 170 billion market cap, wide economic mode, 187 billion, $187 per share right now. EPS or earnings per share right now over $6 per share. PE right now 29 and forward PE of 35 and PEG ratio of 5.4, which is, again, that it is expensive. I know that for sure. I've seen this company trade in the 160s and not long ago, so it's gone up quite a bit. Now, in terms of the revenue side of it, about 3%, 4% growth in the last 5 years, which is not great. EPS about 12%, profit margin 35%, return on equity 36%, return on invested capital 21%. So when you look at this is one of the highest, basically, quality businesses out there. Current ratio above 1. And then when it comes to free cash flow right now, $1.3 billion. Total return the last basically 10 years, we're looking at about 17%, 15%, 14% growth expected in the next 5 years, 28% premium, $146 per share is where they think the price should be. We're halfway there. If you haven't, clicked that like button yet, please do so, because it really, really genuinely helps the channel. Takes a lot of time and effort to put these videos together. I would really appreciate if you could do that. The next one is Intuit Surgical company, market cap of $137 billion. Is a wide economic moat. $386 per share. EPS $5.54. PE almost 70. Forward PE of 6 to 1. PEG ratio 4. So it seems expensive, and it is really expensive. In terms of growth side of things, in revenue and EPS is actually perfect. Profit margin, return on equity, and return on invested capital, not bad at all. PEG ratio about 5. Free cash flow almost $600 million. Total return the last 10 years 26%, 17%, 13% expected growth, 53%. 200 premium right now, $253 per share is where they think the price should be. It's a great company, but it seems very, very expensive. I like the fact that it's actually profitable and is doing well, but it seems very, very expensive. Now you might be thinking, what on earth is going on here? We got Apple here. Remember, I don't really talk about Apple a lot. I've sold it a lot, I think about three and a half years ago. And the time when I sold this company, I really wasn't comfortable where they were heading. They came up with this credit card and they were lining up with other businesses and this and that. So I just took my money and basically invested in other places. But this company is still Sharia compliant. I don't think the credit card has done well at all. Is basically market cap is absolutely huge. According to Zoya, according to other basically platforms that they use, is still Sharia compliant, because the bit of the revenue that is not really compliant is less than 5%. So for that reason, it's still Sharia compliant. It has $2.81 trillion in terms of market cap. As we know, it definitely has a wide economic moat. Price right now $183 per share. EPS $6.43. PE right now 27 PE, forward PE, sorry, and the PEG ratio just above 2, which is not bad at all, but it could be better. I would expect at least like 1.5. PEG in terms of the 5-year growth rate in the last 5 years, we're looking at about 8-9%, then about 18% after the last 5 years. When it comes to EPS, profit margin 26%, return on equity 147%, return on invested capital 66%. Current ratio is above 1, and look at this free cash flow. They can buy a lot of these companies with this type of money. 101, let's call it $102 billion. And remember, they're doing $110 billion of buying back their own shares this year, basically coming years, which is absolutely huge. I think they calculated 460 companies in the S&P. Basically, the money that you so they are buying back, say, $110 billion worth of shares back, right? If they wanted to, they could have actually bought basically there are 460, I think it was, companies in the S&P 500 that have a market cap lower than that, so they can buy any of these companies, which is absolutely ridiculous. In terms of total return, the last 10 years we're looking at about 25%, which is absolutely amazing. 10% growth estimate next year, 11% after that, fairly valued, $170 per share. I would say basically, if you're interested in this company, definitely have some margin of safety, and get it maybe 160 if that was the case, if a market pulls back. Another one that I own in this portfolio is Broadcom, and it has $618 billion market cap, wide economic moat, $1,332 per share right now. EPS to over $26 per share right now. PE about 49, forward PE 28, PEG ratio below 2, which is fine. 5-year in terms of revenue growth side of things, 12%, 31% in terms of 5 years. EPS annual compound annual growth rate. 30% in terms of profit margin, return on equity 24-25%, return on invested capital 10%, and current ratio above 1, $18 billion of free cash flow right now. Total return in the last 10 years, we're looking at about 36%. Growth estimate for next year is 22%, then 14% after that, 22% premium, 1,000, let's call it 1,000, basically is basically what they say in the price should be. I genuinely think if it comes back down to 1,000, it's definitely an attractive company, because based on their expected growth, that should be okay. But right now, it's definitely expensive. Next one is Applied Materials. This is another company that is in the semiconductor company. This is the equipment side of things. $174 billion market cap. Wide economic note, $209 per share. EPS $8.50. PE right now 24. Forward PE of 25. PEG ratio up 2.5. Last 5 years they've grown this revenue about 11%, EPS about 23%, profit margin 27%, 46% return on equity, return on invested capital 33%, current ratio 2.7, free cash flow $7.7 billion, return on equity, total return the last 10 years 27%, growth estimate next year 16%, then 14% after that for the following 5 years, 38% premium right now, $152 per share is where they think the price should be. Next one and the final company is CrowdStrike. CrowdStrike is basically a cybersecurity company, so we've got two on this list, and I think this one is probably the better of the two. 77 billion market cap, narrow economic mode, $320 per share. I can't believe this company is trading this much. Not long ago it was about 160, 170, whatever it was. I think I used to own it, sold it a long time ago. Now they're actually positive when it comes to EPS. For PE right now 874, which is absolutely crazy. Forward PE about 81. PEG ratio though 1.4, which is not bad at all. In the last 5 years they've actually grown that revenue 72%, 76% in terms of last 5 years EPS compounded annual growth rate. Profit margin, return equity, return on invested capital is almost non-existent. Current ratio is above 1. Less than $1 billion of free cash flow. Last 3 years, okay, total return what it was about almost 20%, and the growth estimate next year about 25%, then 30% after that for the following 5 years, which is absolutely huge. It's fairly valued right now, $300 per share is where they think the price should be. Right now it's about 320. This is really a great company. I wish I bought, I wish I kept it when I actually had it in the portfolio, but I did took some profit off the table, which was absolutely fine. Now in terms of Sharia compliance side of things, these companies normally do well when it comes to this side of things because they don't have a lot of debt. Their businesses are absolutely fine, and as you can see, just pause the video basically when you want. But going back here, really great companies. All of these companies are really great. If we see a massive market pullback and maybe in the next by the time we get to September so on, then 10-15% down, these companies will probably be attractive. These are the type of businesses that will do well for you. Like, just to quickly show you the ones that I own in this portfolio. Okay, Broadcom, I'm up 187%. What else do I have? 14%, 15% up into it. What else do I own in this portfolio? I think that's the only two that I actually have on this portfolio. But yeah, so that's the 10 companies I wanted to share with you guys today. Like I've always said to you guys, just to make sure when you're managing your portfolio, it's your money, of course, but always have a balanced portfolio where you've got some growth companies as well as, of course, those dividend paying companies, because it's important and also diversify. Don't just have one type of or one sector, just like looking at this. Okay, let me in fact to show you some of the other companies that are in there. So the top 10 or whatever, you look at Microsoft, Apple, Nvidia, Amazon, and there are reasons why basically I left some of these companies because of Sharia compliant, because of the other situations and so on, political side of things. But you can see there's so many great companies in there, not Intel of course, but yeah, I like KLA as another great company. I've got automatic data processing. So you need some of those type of businesses in your portfolio in order to have that growth side of things, inshallah. Anyway, I'm going to stop here. Have a wonderful day. Assalamu Alaikum.